In 1995, I had my ass handed to me on Swiss franc. I was looking at a weekly chart, and I was expecting this to be some kind of like a bull flag. And this is how the fake bull flags became a thing. I was trying to go long in Swiss franc. I actually told some of my friends, look, I'm going long in Swiss franc. This is what's going to do. I think it's going to go up this much. And what I did not understand is that it was simply going up into a small inefficiency that I understand and teach you now. And it was going to go lower and a lot lower. And that was one trade that I wrestled. I was convinced that it was going to move for me, and I kept opening up my stop, my friends, they got stopped out. I was holding on to it because why did Michael, rookie sensation ICT, why did he think that it was a smart move to keep opening the stop? That means I was widening. Okay, wherever I had my initial stop loss, protect the initial entry long, I was like, okay, I know I'm right, but I'm probably wrong where I'm placing my stop. So I have to just sit through a little bit more. Open it up more and more, a little bit more, open it more. And I was like, okay, now this thing's looking like it really wants to go down, to go right to my stop. I'm going to just take the stop off. Well, that's when it fucking tanked. Okay, and I experienced $6,000 per contract. That's not fun. That's not fucking fun, okay? Especially when you're not in front of the chart seeing it. It's just changing numbers, okay? It's changing numbers on the screen. So I was like, okay, this is bullshit. I gotta get out of this. This is painful. Well, that lesson, that pain, that uncomfortable state would have taken many of you out of this and say, I'm never doing it again. Was I embarrassed because my friends saw me lose big? Yeah, absolutely. I was fucking totally demoralized. But I turned it around and I said, okay, that's never going to happen again. I knew I was wrong, but I arm wrestled it. I knew I was fucking wrong. I was under the pressure of the market's thumb, and it was giving me all the time in the world to save my own neck, and I wouldn't listen. I came in with my preconceived notions that this is what the market's going to do. I married the vein. I sold my soul to that trade. I was not going to let go of it. And it punished me. It tore my ass up. And that's that gapping feature that I tell you about that I was afraid of. That's where I learned that lesson from. Because the Swiss franc just kept going lower. And then in the next session, I'm holding over, it just gaps further against me. I'm like, what the fuck? Clearly, it's got to be done now. Nope. 4 days later, I'm still in there. No stop. No stop. And account gone. So, back to saving money, working on the weekend, delivering pizza, getting some scratch capital raised up again, and I had to go back in and do it all over again. And the only lesson I learned from that at the time was don't hold overnight on futures and currencies because the gaps are too much. That was the only lesson at the time that I learned. But now, knowing back what I know now, there's so many things that I understand about price action that I would never have gone long now. As the trader I am right now, and it's not because I'm hindsight 2020 and everybody could be saying the same thing. I know things that I was falling victim to, and I was not paying attention to it because I was unaware. My understanding of commitment traders was not what it is today. Just simply because the commitment traders were showing long positions by the commercials. That was weeks before. They had switched to being bearish, net short position. That means if you're looking at commercial traders on a net trader position chart, they had more contracts net short than they were net long. So that means that they were shorting where I was buying. And I was that retail Rick that got his ass handed to him. And I learned years later to look back at that and say, oh, shit. This is one of those millionaire mega trades and I didn't even see it or recognize it. So understand, this is the guy that you're learning from, okay? This is the guy that has more understanding today that in the beginning, at that time, I didn't know what the hell I was doing. I was learning all this stuff right then and there. I was learning it. You're having that same right now, that experience right now, but I'm giving you insight that isn't taught anywhere else until they learned it from me. But you can't get it watered down. You have to understand there's a lot more detail to all the things I'm teaching. And just because you're introduced to the idea, don't fall victim to thinking you're ready and go out there and risk money, because you're going to hurt yourself. And that small little hurt, that small little loss incurred, and all losses suck. They do. They absolutely suck. But in the beginning, every loss isn't a paper cut. It's like having your arm cut off. You're losing an appendage. You make it like that. You increase it to that level of influence, impact, when it's nowhere near to the degree that you really think it is when you have experience. Look back and oh shit, that was nothing. You're going to have a whole lot of paper cuts. Sometimes a little bit of gash here, gash there, put a stitch in it, staple it, shut the fuck up and keep going. Do the same thing you've been doing, because you just did one small mistake. It doesn't change the model. It doesn't make the model inefficient. It doesn't make it ineffective. It just means that you messed up as the operator. Own it, move on. Don't dwell on it, move on. But if you have flawed logic right from Jump Street, you're going to lose your ass. And you're going to be miserable at the end of it, because you're going to remember all the times that you subconsciously knew that you should not have been doing what you're doing, but you didn't listen. You couldn't bring the amount of strength and discipline that's required to simply say, I'm getting out of this. This is wrong. I'll worry about making the money back at a later time, but right now I got to stop the bleeding. Because that's the first rule you got to do. Learn how to stop yourself from losing your ass. You're going to lose money, folks. That's a guarantee. You're going to lose money. Every trader loses. They do. I have learned where I lose the most, and I try not to trade in those instances. In April, I took road trips. I said, fuck this. I'm not doing this. I'm not going to get out here and call something that I know the probabilities are so low for me to be accurate. Why? Why feed the trolls? I'm not going to do that. I'm going to practice what I preach. If I don't see some reason for me to be in front of the charts, I'm getting the fuck out of Dodge. See ya. I'm out of here. I had a lot of fun. Relaxing. Spent my time with my family. It was great. And then I got back home when I felt things were changing. You were told in advance where we were expecting the NASDAQ. You were told where we were expecting the euro, the dollar. They behaved exactly as I outlined them. You can't change that. You can't discount it. You can't say it wasn't real. It's not hindsight, and it's not cherry picked. It's 100% understanding. And to answer some of the folks that were crowing to me, can you teach swing trading? Can you talk about higher time frames? I don't want to look at a 1 minute chart. It's just, I'm never going to trade a 1 minute chart. Okay, that's you. But that same idea of understanding what price does and how it delivers, what makes price book the way it does. You can study hundreds of examples over the course of a few months in 1 minute data. And that same logic being applied to a daily or weekly or monthly chart, it's still the same thing. It doesn't feel like that could be true, but it's exactly what it is. Because price, here's the major discovery that I had that was a major epiphany. I thought that the market was independently doing things, randomly all the time. When it's not. It's not doing that at all. It's working from higher time frame charts down to lower time frame charts. It's trading to where liquidity is resting, obvious, below old low, below old equal lows, or above old high, or above relative equal highs. That's liquidity, okay? If you have already ran that liquidity, and you, for instance, let's make the argument that you're bearish, okay? You're bearish on a market, and you want to get short, and you go into price data. Look at a weekly chart. It supports the idea that you think it's going to go lower. Daily chart looks like it wants to go lower. You can clearly see where it would likely draw down to. Some old low or relative equal low. You want to look and see, has it gone into buy side recently? on a daily chart, a weekly chart, or 4-hour chart. If it has and it's sharply moved away and started going lower, you are in right now a sell model. That means it's already started its movement. So someone that we're going to deem as smart money, someone's short. Their interest in this is for it to go to an opposing pool of liquidity, which is what? Sell side. So your first objective is to look for low-hanging fruit. You want to go to you want to go to a 60-minute chart, find some relative equal low or single low that has not been traded to recently. There are sell stops resting below that. That's this market 101. You don't need to read books to know that. It's simple logic. If it moved up from there, chances are someone's holding a long position and their stop loss is right below that low. So the market's going to gravitate to that. If there's a large fair value gap, some kind of a buy side imbalance, sell side inefficiency that's below that, then you can view that as I'm taking a partial at that short-term 60-minute low, and I'm going to try to get into the high of that buy side imbalance, sell side inefficiency, the highest point, which would be like an institutional order for entry drill. If you were long or bullish, we're not doing that here. The example would be making the argument that we're looking for lower prices. You would look at the highest point of that buy side imbalance, sell side inefficiency, and then the equilibrium price point. That's how I would treat it. And then I would wait to see, does it want to move lower? I would use the consequent encroachment of that BISI to trade short if it was supporting the idea it wants to move lower. I would not be trying to trade the full closure of that buy side imbalance, sell side inefficiency. That separates me from the people that think they understand that, oh, it's going to go there because gaps have to be filled. They don't have to do anything. Those gaps can stay there for a long time. And they can stay there longer than your fucking equity can stay in your account, trying to trade to get that gap filled. So there's rules to this.